Okay, welcome to the deep dive.
Good to be here.
So this is where we take your stack of sources, articles, research, your notes, all that,
All that material, yeah.
and we really try to pull out the most important insights, the core knowledge you need without getting totally buried.
Exactly. Get to the essence. Find those aha moments hidden in there. Connect the dots for you.
And today, we are doing a deep dive into sources centered around this really fascinating book, The Psychology of Money. Got it right here.
Ah, yes. Fantastic book. Such a great lens for looking at how we deal with money. It really asks why we do the things we do.
Exactly. And our mission today is to go way beyond just the standard rules, save 10%, diversify,
Yeah.
all the spreadsheet stuff.
The textbook answers.
Right. We want to get into the surprising ways our behavior, our emotions, even our personal history shape our relationship with money and, well, where we end up financially.
It's less about being perfectly rational, like an economist might think, and much more about being, well, reasonable, given that we're human and life is messy.
Yeah, that makes sense. So let's dive in. The source material kicks off with a couple of stories that just, wow, they really show how weird our money behavior can be.
Oh, yeah, they definitely grab you. There's that story about the tech executive out in L.A. Super smart guy, apparently worth a fortune.
And he's staying at this fancy hotel.
Right. And one night, just for kicks, supposedly, he and his buddies are down by the ocean, tossing gold coins into the Pacific, like skipping stones.
Gold coins, just throwing them away. And then there's the lamp incident.
Oh, right. He breaks a $500 lamp in the hotel, and instead of just paying for it, he throws $5,000 cash at the manager, tells him, "Don't insult me," with the actual cost.
It's just bizarre.
Yeah.
Completely illogical financially.
Totally. Now contrast that with Ronald Reed.
The janitor from Vermont, yeah.
Mm.
Lived super humbly, worked his whole life.
Quietly saved, invested in, plain old blue chip stocks, nothing fancy.
And he dies with, what was it, an $8 million fortune. Gives most of it away to the local library and hospital.
So you've got this brilliant tech guy, huge earning potential, literally throwing money away and getting into financial trouble.
Right.
And then this humble janitor with a modest income accumulates millions. What does that tell you?
Well, it suggests that maybe financial success isn't just about how smart you are or even how much you earn, though luck and risk are definitely factors.
Sure, they play a part.
But it really feels like behavior is the giant piece of the puzzle here.
That's exactly the core idea that Big Book starts with. Financial success is less about raw intelligence and much more about how you behave. It's almost like a soft skill.
Which makes so much sense when you think about how finance is usually taught. It's often presented like physics, Here are the laws, the formulas.
Predictable inputs lead to predictable outputs.
Yeah, but living it, actually dealing with money day to day, feels so much more like psychology. It's messy, emotional.
Definitely. Knowing you should save 10% or have an emergency fund is one thing. Actually doing it consistently year after year through ups and downs, that's completely different.
The book draws this interesting contrast with healthcare. We've had these incredible scientific breakthroughs.
Mm-hmm. Understanding biology, medicine.
And they've led to massive, widespread improvements in health across the globe.
Mm-hmm.
Like, fundamental understanding translates to better outcomes for billions.
Yet, in the money world, we've got incredibly smart people, super sophisticated tools, complex models.
Right. Tons of innovation.
But have people, on average, gotten dramatically better at managing their money? Are we less prone to debt, better savers, smarter investors overall? It doesn't seem like it, does it?
No, not really. We still see the same struggles, the same cycles. Why hasn't knowing more made us universally better off financially?
And the huge part of that answer, according to the sources, seems to be the incredible impact of our personal history, our experiences.
This is where it gets really fascinating, I think.
Yeah. The research highlighted here really drives home that each of us has only lived through this tiny, unique slice of economic history.
Right. Like, my experience is totally different from my parents or yours.
Exactly. Your upbringing, the economy, when you first started paying attention to money, your family's attitudes, it all leaves this deep imprint. It shapes how you see risk, reward, everything.
There's that specific study mentioned, Malmendier and Nagel, using the survey of consumer finances data over decades.
Yeah, powerful stuff. They found people's investment decisions throughout their lives are heavily, heavily anchored to what the economy was like when they were young adults.
So if you grew up when inflation was raging,
You're probably going to be way more cautious about bonds later in life, even if the math looks good on paper at that moment.
And if you came of age during a huge stock market boom,
You're likely more comfortable putting money into stocks. It just feels more normal, less risky to you based on that early experience.
so it's not just about your IQ or your financial education. Your appetite for risk is shaped significantly by, well, the luck of the draw when you happen to be born and start your adult life.
Absolutely. Look at Bill Gross, the bond king. His amazing career perfectly tracked this long, multi-decade fall in interest rates.
A huge tailwind.
Huge. And that didn't just make him successful, it likely gave him a fundamentally different gut feeling about bonds than, say, someone from his father's generation who saw bonds get eaten alive by inflation.
Or think about the difference between growing up in the U.S. post-World War II with general stability and growth.
Compared to someone growing up in, say, Germany or Japan right after the war, where everything was just devastated.
Their views on money, markets, stability, they'd be worlds apart. And both totally reasonable given their personal histories.
And this helps make sense of some decisions that seem completely irrational from the outside, like the example given of someone in poverty buying lottery tickets.
Right. Mathematically, it's a terrible bet.
Yeah.
The odds are just astronomical.
Awful odds. But if you try to step into their shoes, the book suggests it might not be about the math. It might be about buying hope.
Hope?
Yeah, like paying $1 or $2 for a tangible dream, a dream of getting the basic things that others might take for granted. You know, a safe home, decent health care, maybe a vacation. It's the story of a different life they're buying.
Puts a different spin on it. It's not just about spreadsheets.
Exactly. So many of our financial choices aren't driven by pure logic. They're driven by our past, our emotions, our ego, pride, keeping up with the Joneses, all these deeply human things.
Which brings us to this idea of enough. Sounds simple, but man.
It's incredibly hard, isn't it? Maybe
Yeah.
the hardest financial skill there is getting the goalpost to just stop moving.
Yeah, because if your expectations just keep rising along with your income or your net worth,
Then you never feel like you're getting ahead. More effort, more results, but no more satisfaction. It's a treadmill.
and that feeling can push you to take on more and more risk, right? Just
Mm.
trying to catch that constantly receding target.
Definitely. Modern capitalism is amazing at generating wealth, but it's maybe even better at generating envy. That social comparison thing is brutal.
A rookie baseball player example they use. Making $500,000 a year. Sounds amazing, right?
Most people, absolutely. Life-changing money.
But if he's comparing himself to Mike Trout and his $430 million contract, suddenly $500 feels like peanuts.
And even Trout making $36 million a year. He's not the richest guy in the room if there's a top hedge fund manager there. It's a game you literally cannot win.
There's always someone with more. So the book argues life's just not much fun without developing some sense of enough. That happiness equation results minus expectations.
You gotta manage the expectations part. And enough isn't about being overly timid or missing opportunities. It's about realizing that wanting more indefinitely can push you too far.
Like eating until you're sick. We get that physically. That last bite isn't worth the agony afterwards.
Right. But financially, people keep reaching. They push until they burn out or make a catastrophic investment mistake.
Or, in those extreme cases like Rajat Gupta or Bernie Madoff.
They cross ethical and legal lines because every dollar, more dollars, felt absolutely necessary no matter the cost. Though most people hit their breaking point in less dramatic ways, like burnout or taking foolish risks.
Okay, shifting gears a bit. Compounding. We all hear about it, but it's still kind of mind-bending.
Totally counterintuitive for our linear brains. Warren Buffett is the go-to example, obviously. Amazing investor.
But the book points out something crucial when he made his money. Most of his massive fortune, like the vast majority,
Came after he was 50. Something like $81 billion out of $85 billion came after he qualified for Social Security.
that's wild.
Yeah.
So his real superpower wasn't just picking stocks.
It was picking stocks well and doing it consistently for an incredibly long time. 3/4 of a century. Compounding needs that runway. Years, decades.
Compare him to Jim Simons at Renaissance Technologies. His fund's annual returns were way higher, right? Like 66% versus Buffett's 22%.
Astronomical returns. But Simons' personal fortune, while huge, is much smaller than Buffett's. Time. Simons started later, so he compounded for less than half the time Buffett did. The book throws out this hypothetical number if Simons had compounded at 66% for 75 years. Some ridiculous number with like 18 zeros, quintillions or something.
It shows the insane power of time in that equation.
Our brains think 8 plus 8 plus 8. Easy, but 8 times 8 times 8. That exponential growth is hard to grasp intuitively.
Even Bill Gates apparently underestimated it initially with Gmail storage back in 2004. A whole gigabyte seemed excessive then. Didn't foresee how fast data needs would compound.
And the absolute key to unlocking compounding, whether it's money or knowledge or anything else, it only works if you can let it grow uninterrupted for a very long time, which requires...
Survival. You got to stay in the game.
Exactly, which leads to this really important distinction the book makes between getting wealthy and staying wealthy.
Okay, what's the difference?
Well, getting wealthy often involves taking big risks, being optimistic, maybe being bold, starting a business, making concentrated bets.
Yeah, you need some guts, some vision.
But staying wealthy, that seems to require almost the opposite traits. Things like frugality, humility, and a healthy dose of paranoia.
Paranoia. Like Michael Moritz at Sequoia Capital.
Exactly, one of the most successful venture capital firms ever. And he says their longevity comes from being constantly afraid of going out of business, assuming tomorrow won't be like yesterday. Only the paranoid survive.
Wow. Think about those stories from the 1929 crash.
Yeah.
Jesse Livermore made an absolute killing shorting the market on the way down.
Brilliant move. Made a fortune when everyone else was wiped out, like Abraham Dramansky, the developer who lost everything, betting it would go up.
Livermore was amazing at getting wealthy in that moment. Came home super rich when his wife thought they were ruined.
Ugh. Fast forward a few years, Livermore lost it all again. Took huge risks, got wiped out, ended up taking his own life. Dramansky lost it all quickly. Livermore took longer. Both were great at getting rich, terrible at staying rich.
So survival really is the key word. It's not about hitting home runs every year. It's about not striking out so badly you get kicked out of the game.
Right, because if you're out of the game, you can't benefit from the compounding, the future opportunities.
Like Red Guerin, Buffett and Munger's partner. Smart guy, same investment ideas.
Just as good at finding deals. But back in the market downturn of the early 70s, Guerin was heavily leveraged. Margin loans.
Ouch.
Yeah. Market tanks, he gets margin calls, has to sell his Berkshire Hathaway stock. Guess who bought it?
Warren Buffett. For cheap.
For under $40 a share. Warren and Charlie had the cash, the buffer, the survival skill. Rick was good at getting wealthy, but didn't have the staying power because he didn't have room for error. Leverage killed him in that downturn, and that staying power made all the difference long term.
This ties right into that tails you win idea, doesn't it?
Absolutely. It helps explain why failure isn't just acceptable, it's actually normal. Even necessary sometimes.
The concept being that outliers, those long tail events, drive almost everything important in finance and business.
Pretty much. Look at the art dealer Heinz Berggruen. He bought thousands of artworks. Most ended up being worth little or nothing, but a tiny handful. Pieces by Picasso, Matisse. They were so incredibly valuable that they accounted for almost all his success. He could be wrong most of the time and still win big because of those few huge successes.
Like venture capital too, right? Most startups fail or just return the investment.
Exactly. But that tiny percentage, maybe 1% of deals that return 20x or 50x or more, they generate the vast majority of the entire industry's returns. One, Google or Facebook, pays for hundreds of failures.
Even the broad stock market, like the Russell 3000 index example. Huge growth since 1980.
Fantastic growth. But something like 40% of the companies in that index basically went to zero over that time. Worthless.
So all the gains came from a minority of big winners.
Yep. A small number of huge successes offset a large number of failures and mediocre outcomes. That's the power of tails.
So the lesson is, it's okay to be wrong. It's normal for things to not work out.
It's totally normal. Good investors aren't right all the time, maybe half the time, if they're lucky. Peter Lynch famously said if you're terrific in the stock market, you're right 6 times out of 10.
Wow, only 6 out of 10 for terrific.
Right. And think about innovative companies. Amazon's Fire Phone. Huge flop. But Bezos didn't hide from it. He basically said, we need to be working on even bigger failures.
And Reed Hastings at Netflix saying their hit ratio is too high, meaning they weren't taking enough risks, weren't failing enough?
Exactly. It's not about avoiding failure. It's about taking smart risks, knowing most won't pan out, but the few that do will be massive. We see the polished final product, like Chris Rock's comedy special.
We don't see the hundreds of jokes that bombed in tiny clubs while he was developing it.
Exactly. George Soros put it best. It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong.
You can be wrong more often than you're right and still make a fortune.
If you manage your downside. If you survive the losses, survival lets the tails work for you.
Okay, so survival lets compounding work, it lets the tails work. What's the ultimate point of accumulating wealth, according to this perspective?
Freedom. That's presented as the single highest dividend money pays.
Freedom defined how?
Basically, the ability to do what you want, when you want, with who you want, for as long as you want. Control over your time.
There was that research mentioned by Angus Campbell, finding that happiness wasn't really tied directly to income level, but strongly to having a sense of control over your life.
Yeah. And that resonates. Think about that investment banking internship story in the book.
Your story, right?
Yeah. High pay, intellectually stimulating work seemed great on paper, but the complete lack of control over my schedule, my time,
Yeah.
it was miserable.
Doing something you theoretically like, but on someone else's clock.
It feels just like doing something you hate. Psychologists call it reactance, that resistance to being in control.
And this feels even more relevant now, doesn't it? The way work has changed. Back in the day, most jobs were physical.
Farming, factory work, you clocked out, work was done.
But now,
Yeah.
most of us are knowledge workers, like John D. Rockefeller, whose job was basically thinking.
Right. His job didn't stop when he left an office. He could be working while sitting quietly.
And that's us now. Managers, professionals. Our brains are our tools. And they don't really switch off at 5 p.m. Work feels like it can bleed into everything.
Always on. And money, savings, wealth. That can buy you an escape hatch. It buys flexibility, the ability to say no, to take a break, maybe change careers, or even stop working entirely if your priorities change, like that story of the father quitting the ER job.
But here's the tricky part. Wealth is what you don't see.
Ah, yeah, the valet experience in LA. You see these incredibly fancy cars roll up, Ferraris, Bentleys.
And your first thought is, wow, these people are loaded, they're wealthy.
It's the intuitive reaction, but as that story about Roger and his repossessed Porsche showed.
Oh, right, the guy who looked rich but was actually broke.
Exactly. All you really know when you see someone driving a $100,000 car is that they have $100,000 less cash than they did before, or $100,000 more debt. You see the spending, not the balance sheet.
So richness is visible spending, current income allowing you to buy flashy things.
Right. Rich people often want you to know they're rich. Wealth. That's different. Wealth is the income you don't spend.
It's the savings, the investments,
Yeah.
the assets working for you behind the scenes, offering future options, flexibility.
And by definition, it's hidden,
And,
invisible.
and therein lies the danger, right? Most people say they want wealth, they want the freedom, the security.
Yeah, the hitter stuff.
But who do they look up to? Who do they imitate? They imitate the rich people, the ones with the visible signals of spending.
Because the truly wealthy role models, the Ronald Reeds of the world, are invisible. You can't learn from or imitate someone whose financial success you don't even see.
Which makes the simple act of just saving money incredibly powerful. Not even for a specific goal necessarily.
Just saving for the sake of saving,
Yeah.
for independence, for control.
Like the oil crisis analogy in the book. We got through it partly by finding more oil, sure, but a huge part was just becoming more efficient, using less.
Conservation. And that
Yeah.
efficiency, that conservation, that was more within our control than discovering giant new oil fields, which is uncertain.
So saving and frugality are the financial versions of energy efficiency. They're much more controllable than trying to guarantee high investment returns.
Totally. Whether the market goes up 10% next year is anyone's guess. Whether you spend less than you earned this month, that's largely up to you.
Wealth is just the leftovers, the gap between your ego and your income, as they say.
And a high savings rate is way more potent for building wealth long-term than just having a high income. Someone saving 30% of a modest income can easily surpass someone saving 5% of a huge income over time.
And the value of wealth is always relative to your needs, isn't it? If you're happy with less, you need less wealth to feel secure and independent.
Exactly. Being content with less is like a financial superpower. It makes you wealthier than someone earning more with higher returns, but who also has much higher expenses and desires.
And saving often boils down to spending less, which comes from desiring less.
Which often comes from caring less about what other people think and what they have. It loops right back to psychology.
So you don't need a fancy spreadsheet projecting returns for your savings goal. Just save. Save for independence. Save for the unexpected.
Which leads perfectly into the next big idea, room for error, margin of safety.
Right. That quote from Scott Sagan. Things that have never happened before happen all the time. History is just one surprise after another.
So planning is essential, obviously. But the most crucial part of any plan is planning for the plan not to go according to plan.
Because the future is just fundamentally unknowable. Look at the last 20 years. 9/11, housing collapse, GFC, tech boom, pandemic. Who saw that sequence coming?
Nobody. So a good plan doesn't pretend the future is predictable. It embraces the uncertainty by building in buffers, flexibility, room for error.
The more your plan depends on everything going exactly right, needing that precise 8% return every year.
The more fragile it is, the easier it is to break when, inevitably, something unexpected happens. Having room for error, maybe only needing 4% when you plan for 8%, makes you robust.
It's like that idea that destruction is part of progress in complex systems. Like synaptic pruning in the brain or creative destruction in the economy, setbacks are normal.
Yeah, but you need to be able to withstand those setbacks. Taking a good idea, like investing, and pushing it too far without any buffer is how you get wiped out. Like a card counter who has an edge but bets too much on one hand and goes broke before the odds can play out.
Leverage is the big killer here, isn't it? It magnifies routine risks into potentially fatal ones.
Absolutely. Ruin is permanent. If you get wiped out, you're done. You can't participate in the recovery or the next opportunity. The homeowner forced to sell in 2009 couldn't refinance at super low rates in 2010. Lehman Brothers wasn't around to buy distressed assets.
The book kind of hints at this barbell strategy sometimes. Take calculated risks with some money, but be extremely conservative, almost paranoid, with another chunk.
Yeah, like ensuring you have enough safe assets that you know you'll survive no matter what happens in the risky part of your portfolio. It might not look optimal on paper, but it maximizes your odds of staying in the game.
And room for error protects you not just from foreseeable risks, but from the truly bizarre, unforeseeable stuff, like mice disabling tanks in World War II.
Exactly. You can't predict mice chewing tank wires. You need buffers for the things you can't even imagine. Avoid those single points of failure.
So saving money without a specific goal isn't being aimless. It's building room for error for life's inevitable, unpredictable curveballs.
Precisely. Okay, next up. The you'll change phenomenon, tied to what psychologists call the end of history illusion.
Ah, right. This is the idea that we consistently underestimate how much we're going to change in the future.
Yeah, we look back 10 years and think, wow, I was a different person. Different tastes, different goals. But we tend to assume our current self, our current desires and values, are pretty much fixed from here on out.
But that's probably not true, is it?
History suggests not. Think about career goals. The kid who dreams of being a doctor finally gets there after decades of work, only to realize maybe that's not what makes them happy anymore. Or wanting to drive a tractor as a kid, and wanting to be a lawyer as a teen.
Our goals evolve. What we want out of life changes.
Dramatically sometimes, and that makes really long-term financial planning difficult. Charlie Munger says, never interrupt compounding unnecessarily. Great advice. But how do you stick religiously to a 50-year plan if what you fundamentally want from life shifts every 15 or 20 years? Maybe our lives are more like 4 distinct 20-year periods than one smooth 80-year path.
So what's the practical advice here? Don't make super long-term plans.
More like avoid extremes in your planning. Don't commit yourself to a plan that requires, say, living on an incredibly low income forever, assuming you'll always be happy with that.
Because your desires might change.
Right. And also, don't commit to a plan that requires working 80 hours a week until you're 65, assuming you'll always value career over everything else.
Because you might regret missing out on other parts of life.
Exactly. Adaptation is powerful. The initial thrill of extreme frugality or the buzz of chasing maximum wealth fades. But the downsides, like having no retirement savings because you live too lean, or having no relationships because you only worked for them, those regrets can stick around.
So aim for balance at each stage. Moderate savings, some leisure time, family time.
Something sustainable. Something that gives you endurance and reduces the chance of major future regret when your future self, who you can't fully imagine now, takes over. Admit you don't know exactly what future you will want, and plan with some flexibility.
Okay. Another core idea, nothing's free, especially market returns.
This is crucial. Volatility, uncertainty, drawdowns, crashes. They aren't a fine you pay for doing something wrong. They're the price you pay for the potential of higher returns over time. It's the cost of admission.
Like paying for a ticket to get into the amusement park.
Perfect analogy. You want the potential thrill of the roller coaster, higher returns, you got to pay the entrance fee. Accept the volatility.
Higher returns generally come with a higher price tag in terms of bumps along the road, Netflix stock. Amazing long-term return, but spent something like 94% of its history trading below its previous all-time high.
Monster beverage. Even higher returns, traded below its peak 95% of the time. That constant feeling of being down from the top is the price you paid for those eventual huge gains.
So you have choices. Pay the price, accept the volatility and uncertainty if you want higher potential returns.
Or choose a lower price, accept lower potential returns for less uncertainty, like cash or bonds.
Or, the third option, try to get the high returns without paying the price.
Which never works long term. That's where you get things like financial engineering that blows up, accounting scandals, hiding risk, GE, Fannie Mae, Freddie Mac before the crisis. They tried to smooth out the bumps, get returns without the apparent volatility, until it all came crashing down.
So you got to accept that market returns have a cost. View the volatility as the fee, not a fine. Figure out what price you're willing and able to pay, and then stick with it.
If you see volatility as a fine, as something to be avoided at all costs, you'll likely panic and sell at the worst time, never actually capturing the long-term returns.
Okay, this links to the you and me idea, why rational people can look at the same situation and come to totally different conclusions about money.
Because they're playing different games. Different goals, different time horizons, different risk tolerances.
Bubbles are a great example, right? Dot-com bubble, housing bubble.
Totally. Think about Yahoo stock in 1999. Insanely expensive by any traditional long-term measure.
But if you were a day trader, just looking to ride the momentum for a few hours or days,
Buying it might have seemed perfectly rational for your game. You didn't care about the 10-year valuation, you cared about selling it higher tomorrow.
whereas a long-term, value-focused investor looking at the same price would think it's completely nuts.
Right. Same asset, same price, different games lead to different rational actions. The high trading volume in bubbles often shows it's the short-term players setting the price.
And the danger is getting sucked into playing someone else's game.
Exactly. Seeing prices go up and up is intoxicating. You start thinking maybe those short-term traders know something you don't, even if your goals are completely different. You abandon your own strategy.
This isn't just investing, it's spending too, right? Keeping up with the Joneses.
Absolutely. You see your neighbor buy a fancy new car or remodel their kitchen. Social comparison kicks in.
But you don't see their bank account, their debt load, their goals, their anxieties. You just see the visible spending.
The young lawyer buying expensive suits might see it as a necessary investment for their career game. Me, working from home, buying those same suits makes zero sense for my game, but seeing others do it can still create that pressure.
So the key takeaway is, figure out what game you are playing. What are your financial goals, your time horizon, your values, and tune out the noise from people playing a different game.
Hugely important. Okay, another big psychological force. The seduction of pessimism.
Ah, yeah. Why does bad news always sound smarter? Why is pessimism so much more persuasive than optimism?
It's weird, isn't it? Pessimism gets attention, sounds intellectually rigorous. Optimism often gets dismissed as naive, unrealistic, maybe even foolish.
But true optimism isn't just blind faith that everything will be amazing.
No, not at all. It's more like the belief that over the long haul, the odds of a good outcome are generally in your favor, even though there will be setbacks and challenges along the way. It's what Hans Rosling called being a possibilist.
So why is pessimism so much more appealing then?
Several reasons, probably. One is just instinct loss aversion. Our brains are wired to pay more attention to threats than opportunities. It's an evolutionary survival mechanism.
Bad news feels more urgent.
Right. Also, money impacts everyone, so bad news about the economy or markets feels universally relevant. It gets clicks, it gets eyeballs.
And pessimistic stories are often easier to tell, aren't they? You just take a current negative trend and draw a straight line into the future.
Exactly. Like that Russian academic, Igor Panarin, predicting the U.S. would collapse into 6 pieces. Front page of the Wall Street Journal. Crazy pessimistic forecasts get headlines. Steady optimistic progress. Boring. Doesn't sell newsletters.
Matt Ridley nailed it. If you say things are generally getting better, people think you're mad.
But those straight-line pessimistic forecasts almost always miss the crucial factor: adaptation. Problems create incentives to find solutions. Threats spur innovation.
Like peak oil fears leading to fracking.
Perfect example. Humans adapt. Economies adjust. Progress happens despite setbacks, often because of setbacks. That's the recurring plot of history, but it's a harder story to see and tell.
Optimistic narratives require looking at the long term, seeing the slow accumulation of small improvements. Negative events are sudden, dramatic, easy to report on.
Think about the Wright brothers' first flight. Barely made the news. Early newspaper stories about planes focused mostly on the crashes. Growth compounds quietly. Destruction is loud.
Okay, let's wrap up the core ideas with when you'll believe anything.
This one is about the power of appealing stories, especially when the stakes are high and you feel like you have limited information or control.
Like that heart-wrenching story from Jason Zweig about Ali Hajaji.
Right.
His son was sick. They had no money.
And they resorted to this desperate, harmful folk remedy, burning the child's chest. Hajaji's quote was devastating. When you have no money and your son is sick, you'll believe anything.
It shows how desperately we grasp for answers, for narratives, when facing high stakes and uncertainty.
And that applies directly to finance. The stakes are huge: getting rich, avoiding poverty, securing your future. And the information is often complex, incomplete, ambiguous.
So people become vulnerable.
Extremely vulnerable to believing overly confident forecasts from TV pundits, to buying into narratives just because they align with their political tribe, or simply because it's the outcome they desperately want to happen. We grasp at stories that reduce uncertainty, even if they're flimsy.
Acting on those forecasts is where the danger lies, even if seeking answers is human nature.
Right. Policymakers even do it, creating appealing fictions, like predicting slow growth in 2008 instead of admitting a likely recession, because the R word was just too scary to face directly.
The alien visiting Earth analogy really captures this. 2007 versus 2009.
Yeah. Physically, the world hadn't changed that much. Same buildings, same technology, same knowledge. But the stories people told themselves about the economy, completely different.
Went from optimism and confidence to fear and pessimism. And that change in narrative drove massive changes in behavior and outcomes.
We're narrative creatures. Even as babies, with almost zero information, we start constructing stories to make sense of the world.
It reminds me of that Clarence Hughes story from medicine, the push for patient consent. Doctors used to think they knew the single right way to cure everyone.
Yeah, doctor knows best. Why bother asking the patient? Just cure them.
But patients have different values. Different ideas about what risks are worth taking, what side effects are acceptable, what constitutes a good outcome for them.
Medicine had to learn to present options and respect the individual's perspective. And finance is similar. A financial advisor might know the statistics, the probabilities, what tends to work on average.
But the right path for you? That depends entirely on your goals, your history, your risk tolerance, what lets you sleep at night, your values.
There's no single financial prescription that cures everyone. It's about applying the general knowledge to the individual's specific needs and psychology.
You got to respect the messiness, the individuality.
Absolutely.
Okay, wow, that's a lot. Let's try to bring this all together now. Summarize the big lessons from this deep dive into the psychology of money.
First, financial success hinges more on your psychology and behavior than on pure intelligence or technical knowledge. It's a soft skill.
Second, your personal history, especially your early experiences with money and the economy, profoundly shapes your financial worldview, often unconsciously.
Third, you have to define enough. Chasing more indefinitely due to social comparison is a recipe for dissatisfaction and potentially ruinous risk-taking.
Fourth, compounding is incredibly powerful, maybe the most powerful force, but it absolutely requires time and survival. You have to stay in the game.
Fifth, getting wealthy and staying wealthy require different skills. Getting might take risk and optimism. Staying requires frugality, humility, and paranoia about avoiding ruin. Staying wealthy is arguably harder and more important.
Sixth, accept that failure is normal. Success in investing in business is often driven by outlier tail events, making it okay for most things not to work out as long as you survive.
Seventh, the highest dividend money pays isn't luxury goods, it's freedom. Control over your time, independence.
Eighth, remember wealth is what you don't see. Savings, investments, while richness is visible spending. Don't confuse them and be careful who you imitate.
Ninth, saving and frugality are your most reliable tools for building wealth and independence because they're more controllable than investment returns. Savings rate matters more than income level or returns over the long haul.
10th, always build in room for error. Plan for the plan not to go according to plan. Protect against known risks and unknown unknowns. Avoid fragility, especially from leverage.
11th, accept that you will change. Avoid financial extremes that lock you in and might cause regret later. Aim for balance and endurance.
12th, market returns aren't free. Volatility is the price of admission. See it as a fee, not a fine. Find the price you can pay and stick with it.
13th, define the game you are playing. Your goals, your timeline. Don't get swayed by others playing a different game.
14th, Recognize the lure of pessimism, but understand the long-term historical power of adaptation, innovation, and progress despite setbacks.
And finally, 15th, be aware that high stakes and uncertainty make you vulnerable to believing appealing fictions. Seek good information, but ultimately the right decision is the one that aligns with your personal goals, values, and psychology. Respect the individual messiness.
Okay, so those are the principles, but how does this stuff actually show up in real life? The book shares some confessions or personal applications.
Yeah, it grounds the theory. A key one is really prioritizing independence and flexibility as the main goal. Maybe even over maximizing every last dollar of return or buying status symbols.
So practically, that looks like living below your means, high savings rate.
Exactly. That creates options. Like the story of the father who could switch careers, leave a stressful ER job later in life because their family had built that financial buffer through consistent saving. The savings created freedom.
There's also the example of choosing to own a house outright, pay off the mortgage, even when rates were super low.
Right. Financially, on paper, maybe keeping the low-rate mortgage and investing the difference looks smarter for maximizing net worth.
Right.
But the feeling of security, the peace of mind from having no mortgage payment, was worth more to them than the potential extra financial gain. It was choosing happy over rational, maybe.
And keeping a big chunk of assets in cash, like 20%. That seems counterintuitive from a returns perspective.
Totally inefficient on paper, especially when interest rates are near zero. Cash barely grows.
Then why do it?
Independence. Room for error. Knowing you have that cash buffer means you are incredibly unlikely to ever be forced to sell your stocks or other investments during a downturn just to cover living expenses or an emergency.
So it buys you staying power, peace of mind.
Exactly. It lets you sleep at night. It might mean slightly lower long-term returns, but it increases your odds of sticking with the plan and avoiding catastrophic mistakes. It acknowledges the psychological side, not just the spreadsheet side.
These examples really show how you might deliberately make decisions that aren't perfectly optimal financially, but are perfectly reasonable psychologically.
That's the essence of it.
The source material also provides this really useful historical detour, a kind of postscript on U.S. consumerism. Helps explain why we think about money and debt the way we do, especially in America.
Yeah, it gives crucial context. It starts with the massive shift after World War II. Before the war, the norm was basically working until you died. Retirement wasn't a widespread expectation.
But after the war, with Social Security getting established, the economy booming, the idea of a dedicated retirement period emerged for the average person.
Right. And this happened just as the U.S. economy needed to pivot from wartime production back to civilian goods. There was huge pent-up demand.
People hadn't been able to buy cars, appliances.
Exactly. And policymakers deliberately kept interest rates low to encourage borrowing and spending, even though inflation was a bit high. Easy credit became widely available.
So you had pent-up demand, easy money, plus all this innovation from the 1930s finally getting deployed.
It fueled this massive post-war economic boom, largely driven by consumer spending, often financed by debt. Household debt actually grew faster relative to income in the 1950s than it did in the 2000s leading up to the housing crisis.
Wow. But crucially, during that period, say 1945 to maybe 1980, the economic gains were shared much more broadly, right?
Yeah, income inequality was relatively low. The bottom and middle grew at similar rates to the top. Opportunities expanded for women and minorities, too.
Which meant
Lifestyles were more similar across the board. People could relate to their neighbors, their colleagues. You measured your well-being against people living lives that were, comprehensible and not wildly different from your own. The rich had nicer things, but not a fundamentally different kind of life.
But then things started to change in the 70s and 80s.
Yeah, growth became much more uneven. Income inequality started to skyrocket. The top tier pulled away. Their incomes grew much faster than the median.
But the expectations didn't change as quickly. People still kind of expected that post-war middle-class lifestyle to be the norm for everyone.
Exactly. As the book says, expectations move slower than facts. People were still anchored to that idea of relative lifestyle equality.
So this led to the big stretch.
Right. The people at the top, with sharply rising incomes, naturally inflated their lifestyles. Bigger houses, luxury cars, private schools, everyone else still wanting to maintain that sense of keeping up, of having a similar lifestyle.
They stretched.
They stretched their finances using debt. Bigger mortgages on bigger houses, more credit card debt, rising student loans, trying to bridge the gap between stagnant wages for many and the rising lifestyle standards set by the top.
Median home sizes exploded. Debt-to-income ratios went through the roof.
So you end up with this culture where taking on significant debt feels normal, almost necessary, colliding with rising inequality. And now you throw social media into the mix.
Where you're constantly bombarded with the curated, visible spending of others, often without any context of their actual financial situation.
It just amplifies that pressure to compare and keep up. This history helps explain so much of the financial anxiety, the feeling of being squeezed, the dissatisfaction we see today. It wasn't just individual choices. It was shaped by decades of these broad economic and cultural shifts.
It really underscores that how we think about money today isn't some fixed truth. It's deeply rooted in this specific historical path.
A very powerful perspective.
Wow. Okay. This whole deep dive really hammers home that money is just so much more than numbers on a page. It's psychology, it's behavior, it's history.
It's deeply personal. And understanding that is, I think, the first step towards navigating your own financial life more effectively.
And realizing there's no single right answer that fits everyone. It's about figuring out what's reasonable and sustainable for you, given your own unique wiring and goals.
Respect the messiness. Define your own game. Find what works for you.
So maybe a final thought to leave everyone with. Given everything we've talked about, how much we change over time, how unpredictable the world is,
Yeah.
could it be that the most valuable financial asset isn't actually the money itself?
What is it then?
Maybe it's the flexibility, the room for error, the adaptability that allows you to navigate the inevitable changes and surprises and keep redefining your path along the way. Is that the real wealth?